Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. In today's video, we're going to discuss the Iron Condor. So, Iron Condor. Opinion is neutral to a sideways market where you'll always collect a credit for this trade. Long one call and short another call with a lower strike. Also long one put and short another put with a higher strike. The call strikes are above and the put strikes are below the current levels of the underlying stock price. And the distance between the call strikes equals the distance between the put strikes. All the options must be of the same expiration. An alternative way to think about this strategy is you are selling a bear call spread and also selling a bear put spread at the same time. You will collect a credit for this trade. So this trade's going to look something like this. Current stock price is $20. You're going to buy one XYZ October 26 call. You're going to sell one XYZ October 24 call. You're then going to buy one XYZ October 16 put and sell one XYZ October 18 put. You will collect a 70-cent credit for this whole trade. Your max loss is going to be $130. Your max profit will be $70 from the credit you collect. And your break even is if the stock closes above $17.30 and below $24.70. Okay, so an example of this trade is selling a bear call spread above the current stock price and a bear put spread below the current stock price. You will want the stock price to close below $24.70 and or above $17.30 at October expiration. You are looking for the stock to trade sideways with defined risk and where both option spreads expire worthless and you keep the full credit. So I have this up. We're going to look and kind of do the same exact numbers on this trade. So we're looking at CCIV. This is what the risk profile looks like. All you worry about is the magenta or turquoise line, okay? So what we're doing is we're selling the 24-26 call spread. We're selling the 18-16 put spread, and we're going to collect 76 cents. Now, we have here, actually, let's do 70 cents, right? So we have a $2 spread, so we know if we're collecting 70 cents and all that expires worthless, our risk is $1.30, right? $1.30 plus 70 equals $2, which is the width of the spread. Now, you can't lose on both sides, right? So if we close between this level and this level, essentially that 24 and change level and 18 and change level, right? We're going to keep the full credit, or actually 1730 and was it 2470 or whatever, right? Anything beyond that, we start to have losses, max loss, right? So this is kind of like, hey, we're giving ourselves a very wide net. That's why we're collecting less. We're kind of risking almost 3 to 1 on this trade. We're risking $1.30 to only make 70 or a 2-to-1, but our odds of winning are so much higher because we actually have a bigger net. We don't have to kind of be very, very kind of like with the butterflies where it's a very narrow move. So we could be wrong up or down and still make our full 70-cent credit. So that is the Iron Condor, how to trade them. Again, me personally, I like to always sell and collect the credit for the Iron Condors. So that's it for this video, and we'll talk to you on the next one.